You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the deep dive. You know, right now, the global markets, they feel like this really complex machine. Almost finely tuned, maybe. You've got this accelerator labeled trade dialogue and then this brake, geopolitical friction.
Yeah, it feels like we're stomping on both at the same time.
Exactly. And it just causes total confusion if you're trying to predict where major assets are heading.
That's a perfect description, really. So our mission today is, well, to cut through some of that noise.
Right.
We're digging into the sources, connecting those policy headlines, the tariff shifts, the geopolitical risks, basically trying to find the key levers, what's really driving currencies, FX, and key raw materials, commodities.
Okay.
And those four areas you mentioned, FX, commodities, trade, geopolitics, they're just locked in this state of like mutually reinforcing pressure. It makes the near-term setup feel incredibly finely balanced.
Okay, let's unpack that balancing act then. We should probably start with those foundational pressures. Our sources are saying trade policy, maybe surprisingly, not central bank talk, is the primary cross-asset driver right now. That feels like a pretty bold statement. Why trade? Why is that the ultimate swing factor, even more than what the Fed says?
Well, because trade policy fundamentally determines things like capital expenditure, right? Where companies build their supply chains long-term.
Okay.
And ultimately corporate profits globally. So when you talk about tariff developments, it's not just hitting a few specific goods.
No.
It's shaping the expectations for global growth overall. And that affects everything from, say, the Aussie dollar all the way to the bond market.
So when you talk about capital recoiling, it's the term used, what does that actually look like? Does everyone just, dump stocks?
Not always, not directly like that. The recoil often hits liquidity first and leveraged positions. So you see a flight from riskier areas, maybe high-yield corporate bonds, for example.
Yeah.
And you see a really rapid jump in implied volatility, especially in currency pairs tied closely to global growth.
Right.
So the capital isn't just fleeing, it's looking for deep, unquestionable liquidity. And that puts immediate pressure on cyclicals and copper and those growth-linked currencies.
And right now, the signals we're getting from the U.S. and China, they feel almost deliberately mixed up. It's just this constant back and forth.
Precisely. You've got the U.S. sort of dangling these broad tariff threats, keeping the escalation option open.
Always there.
But at the same time, you hear officials hinting there's room for actual dialogue. They're signaling they don't want a complete breakdown.
Okay.
And then Beijing, on their side, well, they defended those rare earth export controls, but they framed them carefully as licensing, not an outright ban.
A subtle difference.
A very subtle nod, yeah. Maybe trying to keep some controlled engagement going. But they're still clearly annoyed about new U.S. restrictions, these port fees. It's a very high-stakes, kind of choreographed dance.
But we did see some positive signs elsewhere, right? Maybe smaller scale, but helps the mood a bit. These sources mentioned constructive U.S.-Brazil talks, aiming for a Trump-Lula meeting.
Yes, that's right.
What does a specific bit of good news like that actually do for market sentiment? Is it noticeable?
Oh, yeah. It can give a bit of a green light, particularly for specific sectors, like agricultural commodities.
Okay.
The market reads that kind of targeted diplomacy as reducing risk for futures contracts, things like soy and corn.
Yeah.
And that's actually a key input into global inflation expectations, believe it or not.
Interesting. We also need to watch some really granular stuff, don't we? These potential relief talks, because they could trigger big ripple effects.
Absolutely. There are these reports suggesting the U.S. could announce some limited tariff relief for the auto sector.
Right, autos.
Now, that's not just good news for Detroit. It immediately impacts North American manufacturing currencies. Think the Canadian dollar, the peso.
Yeah.
And it affects global supply chain certainty.
Huge implications.
And then you've got Seoul. They're apparently uncertain if Washington will accept their proposal. Some kind of upfront investment linked to tariff relief. Now, if Washington does accept that, it could rapidly shift things for the Australian dollar, just given how interconnected the supply chains are in that region. These little policy details are driving immediate trading decisions.
Okay, so that covers the trade landscape. But hovering over all of this is geopolitics. That thermostat is just stuck on high.
Yeah.
You said trade might be the primary driver, but these global flashpoints, they're what keep that risk premium priced in, right?
Exactly. And this brings us to a really crucial distinction. What risk is already sort of baked into prices and what risk is maybe ready to unwind if things improve?
Okay.
So thinking about Russia and Ukraine, the sources pointed out the White House called that Trump-Putin call good and productive.
Right, that phrasing stood out.
Yeah. And there are staff-level talks, apparently slated, maybe even a leader meeting in Budapest, to explore ending the conflict.
Now, that doesn't mean peace is suddenly breaking out.
No, definitely not.
But how does the market read that kind of high-level contact?
Well, it takes some immediate pressure off. It suggests the tail risk, the
Yeah.
chance of a sudden really bad escalation, is marginally lower.
Okay.
And that can support equities, maybe curb the most aggressive buying of safe havens. But the Middle East remains really fraught. And that prevents any kind of wholesale reduction of that geopolitical risk premium.
Okay, tell us about that. What's the specific friction around the Gaza agreement that's still causing problems?
Well, the sources noted this persistence of implementation friction. Specifically, Israel is pressing for the return of the remaining hostages' bodies
Right.
and warning of consequences if the terms aren't honored.
Yeah.
So that means the risk of renewed, maybe severe conflict is still elevated. The metric you watch here is volatility indices, like the VIX. As long as you see high VIX levels and people are still aggressively buying gold, that friction is clearly a major market concern.
And we can't forget Asia either. Japan's parliamentary vote for the next PM is still coming up. Coalition math is apparently quite tricky. This isn't just domestic politics, is it?
Oh, not at all. That political calculation feeds directly into how reactive the yen is, fundamentally.
Oh, so?
Well, if the new prime minister ends up relying on a weaker coalition, they might have less political clout, less ability to support the Bank of Japan's very gradual shift towards normalizing interest rates.
Ah, I see.
And that could keep the yen suppressed. So yeah, domestic politics and global finance are completely tangled up there.
Okay, let's pivot to the money moves then. How are currencies, the FX picture, actually trading under the shadow of all this? We have to start with the dollar.
Right.
Why isn't the dollar just soaring with all this geopolitical instability? A lot of analysts would say the greenback should be the clear winner.
It's a great question. And it really highlights the tension that's in the system right now. The dollar is highly sensitive, but there's this strong dovish counterbalance.
Meaning the Fed.
Exactly. Remarks from Fed officials, especially Chair Powell, emphasizing rising risks to the labor market that's kept rate cut expectations alive.
Okay.
And that strong dovish current acts like this huge counterweight, stopping the dollar from just surging purely on haven demand.
So softer U.S. data plus a dovish Fed equals a cap on the dollar, but the sources did mention it found a lift late in the week. What drove that little bit of momentum?
That lift came pretty much only when Washington's tone towards Beijing softened, just briefly. It shows that core dynamic perfectly. The dollar's caught in this balancing act. Policy easing expectations pull it down. But any sign of U.S.-China de-escalation can suddenly push it right back up.
Right.
And, any clarity on big domestic risks like that looming government shutdown threat we keep hearing about, that could also quickly flip the script and give the dollar momentum, maybe regardless of the Fed.
Okay, so when instability does flare up, where is the money running? What are the preferred havens?
Well, haven demand definitely favor the yen and the Swiss franc during those bursts of risk-off sentiment. They just offer that deep liquidity and perceived safety when things feel uncertain.
Makes sense. And over in the Eurozone, the euro seemed to hold up reasonably well, despite a generally weaker backdrop.
Yeah, largely because those French political tensions seemed to ease a bit. That removed one immediate layer of uncertainty for, the continent's biggest economy after Germany.
Okay.
Meanwhile, sterling kind of steadied after some softer UK labor data came out. For the pound, all eyes are now really on the inflation path and, crucially, what tax mix comes out of the November budget.
Right, the budget. Looking across the Pacific now, Asia-Pac currencies seem to be lagging, particularly the Aussie dollar.
Yeah, the Australian dollar definitely lagged. You had weaker jobs data there and a persistently cautious tone from the Reserve Bank of Australia. But let's just circle back to the yen for a second, because it's such a perfect illustration of the complexity here.
How so?
Well, it swings tracked U.S. Treasury yield moves, as you'd expect.
Right.
But you also have this whole domestic debate simmering about nudging Japanese interest rates towards neutral.
Okay, and maybe for the listener, when we talk about the Bank of Japan guiding rates toward neutral, what does that actually mean in practice?
Yeah, good question. For Japan, guiding rates nearer to neutral basically means moving out of negative interest rate territory.
Wow.
For the first time in decades, it's a huge, tectonic shift away from literally decades of ultra-loose policy.
Right.
So that looming policy change, combined with the swings in U.S. yields, it just makes the yen hyper-reactive. It's sensitive to both domestic stuff and global factors all at the same time.
Okay, so we've mapped the policies, the currencies, sort of paper promises, and the safe harbor flows. Now, let's look at the physical side, the raw materials report. Where are those policy bets actually landing in the commodity complex?
Well, precious metals have been the clearest winners from this dual tension. Gold and silver both extended some powerful gains.
Why them specifically?
It's driven explicitly by two things. Safe haven flows, obviously.
Right, the fear factor.
And by easier policy bets, meaning the expectation that global central banks, including the Fed, will start cutting rates sooner rather than later.
Huh. So gold is kind of the only commodity that loves both risk and policy easing. It's basically betting that either the world blows up or the central banks come riding to the rescue.
That's a great way to put it, yeah. As long as those rate cut expectations hang around and geopolitical risk stays elevated, the medium-term backdrop just looks really favorable for gold and silver. It's a powerful kind of self-reinforcing flow.
Okay, but if that risk premise holds true, if global instability is genuinely high, why is oil struggling so much? Doesn't the oil market seem to disagree with gold's assessment of geopolitical risk? Or is it purely a demand issue?
It seems to be largely a demand problem right now, which is why oil drifted lower. Those demand worries are just outweighing the sporadic supply headlines you hear.
Okay.
And even talk about longer-term underinvestment in supply, oil really needs a firmer, more concrete improvement in the global growth outlook to truly stabilize.
So traders are watching key levels.
Yeah, they're watching if WTI crude can find a base near its recent support levels.
Yeah.
But right now, yeah, the oil market is signaling more skepticism about future demand than the gold market is signaling about geopolitical stability. It's a disconnect.
Interesting. And what about the true economic bellwethers like base metals? Copper, the classic canary in the coal mine for global growth.
Yeah, base metals softened, partly due to that disappointing growth pulse we mentioned, and partly because the dollar got stronger towards the end of the week.
Right.
It just underscores how extraordinarily sensitive these industrial metals are to trade headlines, and specifically to China's policy stance. Copper doesn't just need vague talk about dialogue.
It needs action.
It needs concrete steps towards dialogue. Things like clarity on those potential auto tariffs, or on whether Washington accepts Seoul's investment proposal. If those policies move forward positively, copper will likely be the first physical asset to rally and rally hard.
Okay, so putting a final bow on this complex commodity outlook.
Right.
Sounds like we have three distinct tipping points. Gold's momentum really rests on whether those policy easing expectations hold up.
Correct.
Oil needs clearer, firmer demand signals to find a floor.
Yep.
And the cyclicals, like copper, they desperately need tangible, concrete steps toward dialogue between the big trading partners.
That's a precise summary. And if you connect this right back to the core finding from the sources, these four elements, FX, commodities, trade, geopolitics, they're all interconnected, mutually reinforcing pressures.
But trade policy.
But trade policy remains the primary hinge point, the main swing factor.
Right. Concrete steps toward dialogue, lift the cyclicals, pressure the havens. Renewed escalation sends gold higher, keeps capital locked up safe. The market's basically just trading political headlines right now, not really fundamentals.
It captures it perfectly.
Well, this has been an incredibly clarifying deep dive. Really helps to see what's driving prices beneath the surface chatter. Before we wrap up, what's the one high-stakes convergence you think our listeners should really be mulling over, something that builds on everything we've discussed?
Okay. I'd say focus intensely on Japan right now. It really is the perfect case study of how politics, domestic policy, and global finance are converging in this unresolved high-stakes situation.
Okay, why Japan specifically?
Well, you've got significant domestic political uncertainty, right? The outcome of that parliamentary vote for the next prime minister, and then the delicate coalition arithmetic they'll need to actually govern effectively.
And the strength or weakness of that coalition directly impacts policy choices.
Exactly. Then you layer onto that political fluidity the Bank of Japan's own commentary about guiding rates nearer the neutral over time. Remember that huge shift away from negative rates we talked about?
Right, the tectonic shift.
Yeah. Now, imagine a weak political coalition. It might lack the necessary mandate or just the political capital to fully back the BOJ's move towards tightening, even if the economics warrant it.
Potential conflict there.
A huge potential conflict.
Right.
And this combination makes the yen uniquely reactive. It's responding to domestic political maneuvering and those shifting U.S. yields simultaneously. It's just a critical lens to view this convergence of global factors. So yeah, watch those domestic Japanese headlines very closely. They might just determine the direction of the next global risk rally or sell-off.
Fascinating. A lot to keep an eye on there. Thanks for breaking it all down.
My pleasure.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.